Welcome everyone to this public speaking event at the London School of Economics. I'm Professor Ulf Axelson from the LSE, and I'm going to chair this session today. I'm going to start with some compulsory announcements that I have to make. So, firstly, make sure your mobile phones are shut off or on silent. If you post on X, hashtag for today's event is hashtag LSE Private Equity. The lecture that Per is going to give is going to be recorded and then posted on the FMG website. But after the lecture, when we have the panel discussion and questions, we're not going to have a recording. We have a photographer here. If you don't want photos to be posted on the FMG website, please let us know afterwards and we will screen them out. I should also say there's no fire alarm testing today, which means that if there is an alarm, there is a fire. Oh. So then you need to make your way out and follow the instructions of the ordinance. So that's it for the formal announcement. So what we're going to do tonight is Professor Per Strömberg is going to present his thoughts on private equity's role in the economy. He's going to do that for about 30 minutes. Then we're going to have Björklund, who's chairman of Permira Private Equity, someone on the front lines of private equity, join and discuss with Per and me the issues that were kind of brought up with Per's lecture. That's going to be another, say, 30, 40 minutes. And then we will have open for questions from the audience, and hopefully we will be out of here by 8 o'clock. There will be a reception outside afterwards. So let me first start by introducing Per. This is my longtime friend, co-author and colleague Per Strömberg. We met first in military service, but we were very bad soldiers, so we had to become academics instead. Per is actually a double centennial. He's the centennial professor of finance and private equity at the Stockholm School of Economics, but he was also last year the BP Centennial Visiting Professor at the London School of Economics. And this lecture is actually part of your obligations for being that visitor. It was a very good visit because he did my teaching for me, so I could take a sabbatical. Per has been a very prominent academic within finance. His research focuses on corporate finance, corporate governance, with much of it kind of within private equity. He's currently also doing research on climate and the economics of climate policy for firms. He's one of just a handful of people who has received numerous Best Papers Award in our flag. Yeah, some of them are together. In the Journal of Finance. And apart from his important role as a world-leading researcher in finance and economics, he also has a very important role for the whole finance and economics academic community by having chaired the Nobel Prize Committee in Economics, well, it's actually called the Economics Prize in the memory of Alfred Nobel, and is currently going to put a second stint on the committee that elects the Nobel Prize. I think that's all I'm going to say about you, Per. So I'm going to leave it over to you to give the lecture. Great. Here's a clicker.
Oh, thank you. Great, thank you, Ulf. And thanks everyone for coming here. I know the students have to come, but there are a lot of people who didn't have to be here. So thanks for that. No, I'm going to talk today about private equity, and as Ulf mentioned, I worked on research in private equity for quite some time, a lot of it with Ulf, our joint work actually, which is fantastic. This is sort of this framework I'm going to present to you is a little bit of how things have kind of, having digested this for a couple of decades, I've sort of come to a point where, okay, this is the way I think about private equity. Okay? So it's not really a theory, I call it more of a framework. We'll see what the academics think of it, but it, at least for me, has been helpful to try to understand private equity and put it in perspective, the role it plays in the economy. So that's what I want to talk about. Just to be clear, I don't think it's surprising to anyone that private equity has been growing a lot since it, I guess we can say the modern private equity emerged in the around 1980 in the US. This graph shows you the fraction of, the right one, private equity capital under management as a fraction of GDP for North America, Europe, and the rest of the world starting in 2000. Sort of the halfway point, if you will, in the life. But it's a phenomenon that has been growing, okay? So that if you look at Europe, for example, it's grown about fourfold over the last 25 years as a fraction of GDP. Why is that? Okay, and the other thing that my talk is going to be primarily about buyouts, private equity buyouts, but I do think that some of the aspects of this framework, and maybe we'll get to that in the discussion, might actually apply to private capital more broadly. And private capital, buyout is part of private capital, the biggest chunk of the private capital market, but the private capital has also grown dramatically over the same period. Now, not only has the market grown, but the research on private equity has grown as well. I don't know if how many people recognize this person here. This is Michael Jensen, who sadly passed away 2 years ago, before he had the chance to get the Nobel. No, strike that from the, actually it's a public, okay. Shouldn't talk about that, but anyway, Michael Jensen is the founding father of corporate finance, corporate governance research, a great thinker in finance. He also happens to be the founding father of private equity research. So he, the first sort of classical articles that took private equity and buyouts to the academic arena were these two articles, one from 1986, one from 1989. The 1989 article, interestingly, is entitled "The Eclipse of the Public Corporation." Okay. Michael Jensen was very bullyish, very positive about private equity. He thought this is a fantastic way to own and manage firms. And, it's going to take over the world. In a couple of decades, there won't be any public company left. Okay? Everything will be PE owned because it's so amazing. Okay. Now, I think that prediction maybe hasn't lasted, but we've seen it growing a lot, at least. And following Jensen, researchers have followed his program and started to look at the effect of private equity on the firms they own, how they add value, and so forth. So this slide is trying to maybe summarize 40 plus years of private equity research in a couple of bullet points. Okay, so just if you take the overall first order view of this, some studies say X, some studies say Y, but the overall picture, at least the way I interpret it, is the following. Okay, so first there's a bunch of research on what happens to firms when they become owned by private equity owners, buyout funds. And despite a few some results going in different directions, the overall picture is very positive. Okay, so in that sense, Michael Jensen was right. So after firms get acquired by private equity funds or private equity owners, that's productivity goes up, growth increases, profitability goes up, efficiency goes up, management practices improve, and so forth. Okay, so that literature, by and large, is very positive on private equity. Second, group of papers then have tried to understand, okay, what do these private equity owners do to create this, to increase productivity and growth in this way? And so there's a literature on how do private equity owners differ in the way they work with their companies as opposed to other owners. And Steve Kaplan and I wrote a paper 15 years ago where we distinguish 3 types of what we call engineering, 3 types of tools that PE has in their toolbox. One is governance engineering, okay? This is basically, and this is, I think, is the core to what private equity is. Private equity is a way of, is a governance form, and it's basically a way of being an active owner in companies, okay? And as an active owner, then the PE model, will work with smaller but very active boards, and very active in recruiting and replacing and incentivizing management and employees. Second group of tools, second type of engineering, we call financial engineering, which has to do with optimizing the capital structure of the firm, trying to reduce the cost of capital by being smart about financing. And as probably everyone knows, the PE capital structures tend to be quite levered compared to comparable non-PE owned firms. And the third group of tools, which actually when Steve and I wrote this paper, was not, to be honest, that prevalent, but I think nowadays, and we'll probably hear from Kurt, is one of the things that private equity owners like to market the most, is that they're not just financial engineers or know how to structure incentives for management, but they actually are becoming sector experts. They have in-house operational and strategic knowledge, industrial networks of executives they can put in boards, and so forth, operating partners that they use to assist management and support management in increasing productivity. Okay. So that's the second group of papers. Then there's a third literature that focuses more on, okay, but is this a good, is private equity, what does it look like an asset class? What are the risk-return properties of private equity? I would say that this is still in literature that really hasn't settled. So for example, if you ask me what's the Sharpe ratio of private equity, I don't think anyone has a good answer to that. But what we do know is that historically, the returns of private equity funds, net of the fees they charged, have exceeded public equity in this index returns by something like 2-3% per year. And then finally, this is all very positive. If you go to maybe the less positive, or at least a bit more ambiguous in terms of economic welfare, is that the private equity market is very cyclical, exhibits cyclicality in many different dimensions. So private equity fundraising tends to be very cyclical. Private equity activity tends to be very cyclical. And when private equity, at the top of the private equity cycle, when there's a lot of fundraising, a lot of activity, valuations, deal valuations or transaction prices in buyout transactions tend to be higher. Leverage in those transactions tend to be higher. The productivity improvements, the subsequent productivity improvements in portfolio companies actually tend to be lower in the transactions that happen at the peak. And the net returns to the investors in private equity funds also tend to be lower for funds raised at the peak. Okay. So this is at least my quick view of this, what we know from these 40 years of research. Now, I think these results, they raise a number of questions that we want to answer, that I hope at least to maybe give some partial ideas of answers. The first one is, okay, what's so special about private equity? Okay, so we talk about these buyouts, we talk about private equity, where it's about owning equity in firms that are not listed. Okay, what's so special about not being listed? And second of all, okay, let's we've seen these studies that private equity on average seems to be great for increasing productivity and growth in firms. Well, why aren't then all firms private equity owned? Shouldn't that be optimal? Okay, shouldn't, like Jensen's prediction about the eclipse of the public corporation, why is that correct actually? Is it optimal for every firm to be PE owned? Well, okay, maybe you can think that maybe that doesn't make any sense, but okay, these tools then, the engineering tools that give rise to these productivity gains, why don't other firms do the same thing? Why don't they also have active boards? Why don't they also have equity incentive programs for management and use more leverage or have in-house operating partners? Okay? What's so special about private equity in this respect? Third question, if you look at historical performance, and I do think this is quite sort of controversial among academics, we see this historical return of, let's say, 3% above public markets. But we also have a relatively short time series. Is this just luck? Do we expect to see this continue in the future? And how should we interpret this outperformance? Is this alpha? Is this like, oh, we should really invest in private equity because we get consistently such a much higher return? Or is it something else? And finally, we have this very high degree of cyclicality in private equity activity. Why? Okay. What drives that? So that's what I want to talk about now. Okay. Now, to start with, I think that to understand private equity, and what's special about private equity, I think you need first to understand why we need public equity, okay? Why we need listed markets, okay? Because I think that's, so let's start there, okay? And this is actually something that we, finance research and economists have studied for a long time, and, since I was a number of years on the economics prize committee, I've listed some economics prize winners that are associated with the research, these insights. So on the top there, Markowitz, Tobin, Sharp, Miller, Modigliani are basically, their pioneering research showed us that if you have, you can trade and diversify in public markets, then investors are able to achieve higher risk-adjusted returns. Okay? They can get to the efficient frontier. Okay? And that's great for investors because they get a higher return for a given risk. It's also great for firms because the expected return of investors, the required return of investors, is the cost of capital of firms. So if that, you become more efficient, we can drive down cost of capital to firms, increase investment, increase growth, and that's great. Okay. And so public markets is primarily about giving liquidity to investors so that they can diversify, rebalance, and lower their risk or increase their risk-adjusted returns. So that's the top row there, I would say. Then there's the second row of Nobel laureates. We have Akerlof, Wilson, Milgram, Diamond, and Holmström are all people who have worked on frictions, market frictions, and particularly what happens when you have asymmetric information in markets and adverse selection in markets. And I guess one of the big insights of their work is that to get liquid markets, you have to remove asymmetric information. Asymmetric information and adverse selection is the biggest enemy of liquidity. Okay? Some of you may know the famous Akerlof 1970 paper on the used car market. Used cars is a hugely, a market with a huge amount of adverse selection. You buy someone's used car, chances are there's a problem with it because otherwise why would that person be selling it? Okay. And the problem with asymmetric information is that if you have a market where you think that when you make a trade, you're trading with someone that has way better information than you have, well, then you're going to be on the losing side of every trade. If you buy something, chances are you're buying it too expensively. If you sell something, chances are you're selling it too cheaply because your counterparty has better information. So markets where market participants know that there's a ton of informed people out there, well, they're not going to be very liquid. Okay? They're going to have high bid-ask spreads, low volume, or may not even work at all. So that's why we have securities regulation. One of the things you need to have to get stock markets to work is to have rules on disclosure. If firms give out a piece of information to one shareholder, they have to give the same piece of information to everyone. You have insider trading rules. If you're an insider, you're not allowed to trade. You have to give up liquidity, prospectus requirements, etc. Okay, all of these things are to get an informational, level informational playing field, if you will, so that you remove as much of this asymmetric information, adverse selection as you can to get liquid trading. Okay. Now, this all great. Okay, we can get liquid markets to work. There's a second thing, though, we would like to get from stock markets, and that's good governance. Okay? So there's a big literature, and this is where Michael Jensen was one of the pioneers, studying the corporate governance problem. How do we get firms to be run in the interest of stakeholders? And I guess more specifically, in Jensen studied a lot, how do we get the management team of a company to act or make decisions in the interest of shareholders and not in their own self-interest. Okay. And there's a ton of literature on the costs of these types of agency problems that, eventually, if you have a hard time controlling or aligning the interest of managers and owners, you're going to get suboptimal actions being taken, you're going to get lower productivity and growth in companies. Okay. So the role of corporate governance is to try to align the interest between managers and stakeholders, managers and owners, to lower these agency costs. And I think one of the most important solutions to get strong governance is to have active and informed owners that monitor management, that knows what they're doing, that can fire them if they don't behave, and so forth. Okay. So active ownership, active and informed and empowered owners is key to get strong governance, and strong governance is also key for economic productivity. Now, the problem here is there's a conflict between these two goals, okay? Because the strong governance, being an active owner, means that you're going to be an informed owner, you're going to be following, you will be discussing business plans with management, you will be knowing a lot about the strategic moves of this company, a lot of proprietary information that the market doesn't have, okay? Well, that's great for monitoring, great for corporate governance, but you give up liquidity because you're an insider, okay? You can't trade. And when you give up liquidity, well, that has a cost in itself that's going to increase the cost of capital for firms. Okay. On the other hand, we take the public company model with dispersed arm's length owners that know lots of owners and everyone has the same information. Well, no one really knows what goes on in these firms, which means this comes at the expense of corporate governance. Okay. So these are sort of, I think this is about I think about this as sort of the generic problem in corporate governance, this conflict between governance and liquidity. Okay? If you want to think about this more mathematically, I think strong governance is about maximizing cash flows, but liquidity is about lowering the cost of capital. Okay? How do we get this to work? Well, I haven't said much about private equity yet. Now here it comes. Okay? Private equity is as you know, it's a financial intermediary, that invests OPM, as academics call it, other people's money. Okay? So it's a financial intermediary that raises money from institutions and invests it in companies. Okay? Now, the reason, at least the way I think about it, and actually Michael Jensen thought about it, why did this new institution emerge? Well, it's attempts to solve this conflict between governance and diversification and liquidity. Because the ultimate investor, let's say a pension fund, okay? Pension fund needs to be diversified, it needs to have enough liquid assets, it doesn't have the resources to be an active owner in all of the firms that they own. Okay? But what this pension fund can do is they can take part of their capital, put it in a couple of private equity funds, and these private equity funds in turn take big concentrated ownerships in a dozen firms where they act as active owners to create, improve governance and create value. Okay? So with this sort of new institution, ideally, you can have the cake and eat it, okay? You can get the high level of diversification, enough liquidity for investors, and at the same time get strong corporate governance in firms, okay? Problem solved. I'll skip this for the sake of time, but, okay. 2 seconds on this, I love the slide. Now, you may say, well, what about in public markets? People talk a lot about corporate governance in public markets. You know, we have big institutional investors in public markets. They say, oh, we're super active in governance. It's very important for us, okay? Well, I do think the more I learn about private equity governance, it's apples and pears. So it's really a huge contrast in the level of activity that public and private owners have. So just an example, okay, BlackRock or CalPERS would say, well, we're very active in governance. We vote on every shareholder proposal, and we have strong opinions on these shareholder meetings. We voice our opinion if we don't like what the company is doing, and we attend every quarterly earnings call, and and so forth. Okay. Well, in the private equity, you don't have a view on who should be on the board. You decide who should be on the board. You don't have a view on management. You decide who's going to be managing the company and how those people are going to be compensated. You interact weekly. You have access to any piece of information you would like to know in this company, proprietary or not, you have access to. Okay. So that's, I would say, the PE governance advantage. However, okay, why aren't then every firm PE owned? Well, because private equity comes at a cost. Okay. One cost we've already discussed. If you want to have active ownership, informed ownership, you need to give up liquidity. Okay. And investors like liquidity because that enables them to diversify, rebalance, and so forth. Which basically means if you're going to invest in private equity, you're going to lock up your capital in this illiquid asset, you will demand a higher return than if you invest in public markets. And this, to me, given that, it's not very surprising that private equity funds net of fees have outperformed, or not outperformed public markets, right? Outperformed in quotation marks, because this, if you didn't get a higher net return investing in private equity, why would you invest in private equity? Why would you give up liquidity? Okay. That's the first cost. And let's say, if we look at the historical outperformance of PE of 2 to 3%, at least I would say, well, that's probably a pretty realistic size of this liquidity premium that investors require. The second cost is, well, this having the fund and having the cake and eat it, it's not quite that easy, because what you're doing is maybe you're solving the governance problem between shareholders and companies, but you're introducing a new governance problem between investors and private equity fund managers, okay, that you need to align those interests. Okay. And what's the cost of that? Well, how these incentives are aligned through various different ways, but one of the ways it's aligned is the way you compensate the fund manager for fund management with fees and carry. And those fees and those carry, the 220 model, if you look at that cost as a fraction of assets under management, you will, when you do a simple spreadsheet, we do this in our course, you get the order of magnitude of 5, 6, 7% of assets under management. This is huge, right? Investing in an index fund, you pay 10 basis points. Investing in an active mutual fund in the public market, maybe you pay 1%. Okay, now we're talking maybe 6%. So what does this mean? Well, it basically means that, okay, sure, private equity is a great, active owner, can generate increased productivity, generate a lot of value through active ownership, but they need to generate a lot of value to meet the high costs of private equity. That may be, if you think about 2-3% liquidity premium, 5 to 7% fees and carry, well, that basically means unless you generate 7, 8, 9% higher return in the PE investment than what you could get in the public market, alpha in this size, well, then you're not going to break even, right? Your LPs are not going to get the compensation they require. So here, now, what are the implications? Well, first of all, why aren't every firm why isn't every firm private equity owned? Well, because even though maybe every firm would benefit, everything else equal, from having an active owner, like a private equity owner, not every firm will benefit enough to justify the cost. Okay? So if you would sort firms according to, where the ones that would benefit the most from active ownership, private equity ownership, and towards the ones that benefit the least, and there's a cost of private equity, well, only the firms where the cost is sufficiently high should be PE owned. Okay? So private equity should not own every firm. Second implication of this is it's a similar picture, but now instead of sorting firms, I'm taking a given PE-owned firm and move it. Let's see what happens over time. Okay? And I think it's very natural that a lot of the benefits from having an active owner, eventually the benefits will taper off. Okay? Eventually we've fixed what needed to be fixed. We have the best CEO, we have the best compensation, and so forth. We've done, these things we needed to do, and the marginal benefits, even though they're positive, they start to decline. Okay? But at some point, the benefits of continuing to be in PE ownership are likely not high enough to justify the cost of private equity. Well, then you should sell, right? Then you should exit. So private equity is very, very natural when you think about it this way, that private equity is not a permanent ownership form. It's a temporary ownership form. Okay? And when we think about private equity funds, one of the things people criticize is, they become very short-term because the funds have a limited life. Well, the funds should have a limited life because it's very unlikely that you can go on and add enough value to justify the cost for, much more than, let's say, 10 years. Third implication has to do with leverage. Okay? So just to, all the finance people have studied finance in the room, which I take is quite a few of you. Everyone knows about the Miller-Modigliani theorem, where basically the idea is, okay, capital structure doesn't matter for your cost of capital. The only thing that matters is how risky your business is, and the capital structure is just a way of dividing cash flows between debt and equity, but the sum of the cash flows is still the same, and the risk is the same, and cost of capital doesn't depend on capital structure. Okay. Now, when we teach this, we say, well, there are various frictions that change this trade-off. Well, one PE-specific friction is that for private equity, given the illiquidity and given the fees, it's actually way more expensive than debt financing. Okay? Because if you borrow from a bank, you don't have to pay fee and carry, and you don't have to offer a liquidity premium. Okay? So this means basically that the more, absent everything else, okay, the optimal capital structure of a PE-owned company with no other frictions would be, a small little, super small fraction of private equity and most of it debt, because that would minimize the cost of capital. Well, we all know that wouldn't be very realistic because there are costs of bankruptcy and so forth. Okay? But what's pretty clear is that if you look at the optimal level for a public company, then take the same company, switch it into private equity ownership, the optimal level of debt is going to be much higher because private equity is much more costly than public equity. And last implication, which relates to the leverage point, is the cyclicality. So why do we see private equity markets being so cyclical? Well, the cycles you see in private equity vary, as people have shown, a lot with liquidity preferences. So for example, the top of the cycle is also when a lot of funds are raised in private equity, which basically means, or would be at least consistent with liquidity preferences, or people being more illiquidity, willing to take on illiquid assets in booms. And they also tend to be periods when you can borrow more. Okay? So the more you can borrow, okay, the lower the average cost of capital is going to be, because you only have the PE cost for a part of the capital of the firm. Okay? So let's say that you have a 9% extra cost of private equity. Well, if you finance a deal with all equity, you need to generate a 9% alpha on this company, on this asset, for your LPs to break even. Let's say you can finance half of it with debt that doesn't have an extra cost. Well, now we're down to a 4.5% alpha you need to generate on that asset, right? So the more debt you can get, the less value creation you need to do in the company to get the sufficient equity alpha for your investors to break even. Now, imagine the top of the cycle where there's lots of liquidity and you can borrow a lot in your transactions. Well, in those markets, you have a relatively low cost of private equity. The average cost of capital cost for private equity is going to be relatively low. You can borrow a lot. That basically means you have a lot of viable targets. Targets where you can only add marginal value are still going to be economically, profitable, given that you can use a lot of leverage. Then, market conditions switch. We get into a financial crisis or a cold debt market. Maybe you can only borrow half as much in those market conditions. Well, then you need to generate a much higher productivity improvements or alpha on the assets. Okay, so very much fewer firms are going to be viable targets in those cold market conditions, and you will see fewer deals being done. So what you get from this framework is this covariation between the liquidity of debt markets and the liquidity of markets in general and private equity activity. The other thing you get from this, which is that if you look at the average value creation of deals in deals done in cold markets, you take the integral, under the curve here. Okay. The average value creation in deals done in cold markets is actually much higher than the average value creation in deals done in hot markets, which is what we see in the data. So this is just an example of that. This is from a paper by Steve Davis and co-authors, where they look at hot credit markets, which is to the left, and cold credit markets to the right, and they look at the relative productivity increase in PE-owned firms, and you see that in the hot markets you have significantly less productivity improvements in deals compared to in cold markets. Many people interpret this as, market irrational exuberance and so forth, but I think it actually quite naturally comes out of an equilibrium framework like the one I proposed. Finally, and this is maybe not something that's been tested, but you can get the same relationship between where you are in the cycle and the optimal holding period, and this actually has implications too for what you do with leverage recapitalizations, because leverage recapitalizations is a way to reset your capital structure, reduce the cost of private equity capital, allowing you optimally to hold a firm a little bit longer. So let's end it there. So what I'm trying to argue, first of all, private equity, in my opinion, is about the benefits of active ownership. Active and informed ownership, and the productivity improvements and growth improvements we see in firms, well, that basically shows you that the value of having an active and informed owner is very high. Now, being an active owner means you have to give up liquidity, because when you're an active owner, you're going to be better informed than other investors. You're going to have to give up liquidity. And you also have a bigger stake, which also makes your ownership less liquid. That basically means that you get a trade-off between the benefits and the cost of private equity in terms of liquidity and in terms of the LPGP governance costs, which then implies that, well, not all firms should be owned by private equity. Not all firms are viable targets. Private equity should have a limited holding period. Debt is cheaper than private equity, so private equity-owned firms should have higher leverage levels. And you get cyclicality, where buyout activity, value added, and net returns will vary with leverage and liquidity cycles. So that's it, folks.